If you invest in residential property, how can you be sure it's going to work out for you? At some time, the current property boom is going to come to an end. So are you going to own the right types of property at that stage? That's what we're going to discuss in today's show, because if you're going to borrow money to invest, and if you're going to take on the risks of investment, and boy are there risks, you need to ensure that you get wealth-producing rates of return, not just during this boom time when most properties are going to go up, but over the long term. So today I'm going to be chatting with Brett Warren, National Director of Metropole Property Strategists and one of my business partners, to give you some insight to ensure that you make the most of this property cycle. Now here's a spoiler alert. You must own quality assets. The quality of your asset will determine the level of your success. In my mind, the quality of your assets will determine 80% or so of your financial outcome. You know, how much money you're going to make. That is, if you invest in high-quality assets, you should expect high-quality returns. And of course, the reverse is true. Therefore, to increase the probability of being a successful investor, or to put it differently, to reduce the risk of being unsuccessful and ending up with no properties or only one or two properties like 92% of those who get into property investment do, you need to focus your energy on only investing in quality assets. So welcome to today's show, because at the end, I'm sure you're going to have a better understanding of what to look for and what to avoid.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Better not miss out on this property boom, because it's going to be a long wait before the next property cycle comes around. And in my mind, the intensity of this boom is a once-in-a-generational opportunity, and it's not too late to get into the cycle, but I'd like to make sure that when the cycle eventually finishes, you're in the right spot and not left high and dry. And that's the topic of my chat today with my business partner and National Director of Metropole, Brett Warren. Hi, Brett.
Hi, Michael. Good to be with you.
Now, Brett, the idea of this little chat we're having today came around from one of your regular weekly blogs or vlogs, because you do a video as well, and you mentioned the idea about a rising tide lifting all ships.
Yeah, look, it was an interesting quote that I've heard previously, and it came from John F. Kennedy, who coined it back in 1963 in relation to the improving US economy and the fact that everything is going to be lifted up with the economy. And it made me think of the Australian property market at the moment. You know, I think it's a very dangerous time. I think probably no matter where you buy in the next 12 months, you're probably going to do okay. But as we talked about before, we've mentioned what Warren Buffett mentioned after that point. So I just thought it'd be a good opportunity to write and talk about that.
Well, I guess Warren Buffett's comment was, when the tide goes out, you see who's swimming naked. So I think the concept really is you can't just buy any property. You don't want to end up at the end of this boom and find you're holding the wrong property, one that doesn't increase in value, one that doesn't go up by wealth-producing rates of return, or even worse, one that goes down in value. And Brett, we've seen that in previous cycles where it all looks good until it ends, and then you see property values dropping.
Yeah, we certainly do. And you know, like we talked about before, sometimes people get wrapped up in the emotion that it may last forever and the good times will keep continuing. But we know that's not the case. And it's what happened next that counts, I guess, in the scheme of things.
Well, let's start with some basics. The drivers of this property boom, in particular, it's low interest rates. People are upgrading. It's creating demand because interest rates are low, so people can get into their first homes or upgrade their home or move to different locations. So there's a wide range of upgraders. But there's also a palpable change in consumer confidence, isn't there?
Yeah, it certainly is. I mean, that's at record high. I think there's a lot of pent-up demand coming off the back of, you know, the lockdowns, and, you know, certainly there's probably a lack of good quality stock and quite large demand. People are moving and changing. Demographics are shifting. I notice, millennials are starting to move into that family formation stage, So they're leaving those 1 or 2 bedrooms behind in the inner city and moving out to the inner city suburbs or the middle ring suburbs as well. And also, how we want to live is changing, Michael. And we talk a little bit about high rise versus moving out to the middle ring suburbs as well. And that's going to include more infrastructure improvements and things like that also.
So, first of all, very few of us now want to live in those high-rise apartments. More of us are wanting a home or a family-friendly apartment. So there's a lot of drivers for this cycle. And when our research department has worked out what the change in affordability is based on lower interest rates and wage increase, and there are some people in this community who are getting higher wage increase, the suggestion is that based on those figures, this cycle around, property values should increase by about 25 to 30% because people can afford that based on lower interest rates remaining for a while. Now, of course, not everyone can, but we're not suggesting you buy any type of properties. So the suggestion is that most of 2021 and 2022 property values will keep increasing, but not at the same rate. They can't at the same rate as the first half of the year. But I think when you move forward, 3 years, 5 years' time, you're going to find that property values have risen significantly. In many cases, in good locations, they'll have gone up 25 to 30% over the cycle. And at that stage, our economy will have picked up. We hope that we're not going to be worried about COVID much anymore. And wages will have gone up. That's what the RBA is trying to do. It's trying to push up wages, and it also hopes to push inflation up just a little bit. And then, and only then, the Reserve Bank is going to start rising interest rates. But in my mind, Brett, wages are just not going to have gone up anywhere near the level of property value increases. And that means some people are going to just find property too unaffordable.
Yeah, look, it certainly looks that way, particularly at the moment, Michael, when, people are talking about maybe the RBA will step in or APRA will step in. And look, that may eventually be the case. But again, it's going to be the people whose incomes are rising and are increasing faster, who have the ability to pay more for property, who've got higher rates of savings. They're really going to outperform those kinds of pockets and those kinds of suburbs. So clearly they're the kind of areas we're trying to identify and put our money in for the longer term.
Well, as we've spoken about in previous podcasts, the Australian Bureau of Statistics divides us all into one of 5 skill levels, and that's related to the sort of jobs you've got, which is related to the sort of income you're getting. And people with skill level 1 and 2 jobs are getting higher incomes, and they're the ones who have often got multiple streams of incomes because they've got a share portfolio or they've got property portfolio or businesses. And for that reason, they're the ones who are going to be able to afford more. While, as I said, moving forward 3 to 5 years' time, when property values have increased a lot, the average Australian, middle-class Australians and the lower economic groups, and this is not a judge of people, but it's just a fact of how wealth is distributed in Australia, those people are going to have some trouble. So I think it's going to be really important that at the end of this cycle, you own the right type of property. Yet currently, Brett, we're seeing FOMO, fear of missing out, meaning many investors are making poor investment decisions.
Yeah, they are. They're making short-term decisions based on emotion. They're not taking a strategic approach. They're maybe going off a gut feel or rushing into the market to get in as early as possible to make the most of this wave. But, they really need to start considering what type of property will be more popular over the next 10 to 15 years, what type of location is going to be more popular, because it's probably likely going to be very, very different to what they're focusing on and what they're hopefully not missing out on in this cycle, if that makes sense.
Sure. So if they end up owning the wrong property at the end of this cycle, they're going to miss out on the capital growth. But as I think you mentioned a bit earlier on, at the beginning, at the moment, it all looks very good. It all looks much the same. But we've seen those charts where some properties increase in value at 5%, some at 7%, some at 10%. And early in the piece, those graphs that are moving up look much the same. But the further out you go, the bigger the gap, the bigger the difference is. And I guess that's also the bigger the opportunity cost.
Yeah, look, it certainly is. Look, in my article, Michael, I did use the difference between a fully established area like Sydney and a suburb like Perth, which is a bit kind of boom and bust. And I think most economists and most commentators are saying that Perth's going to perform particularly well in the next couple of years, and I'm sure that will actually be the case. However, what's going to happen in 10 or 15 years? I think if you rewind back to 2006 and 7, the Perth median house price was actually level with Sydney almost at one stage. And as we know what's happened from there, Perth's had 50 odd quarters of negative growth and really trended backwards and sidewards. And Sydney's gone on to double in value. So I don't think there's a better example than those two particular cities.
Well, we've seen it in mining towns. We've seen it in off-the-plan properties. So when you retire, and that may well be, I don't know you, for 5, 10, 15, 20 years' time. I'm not talking to you, Brett. I know you're not going to retire. You're going to be my partner for a long time. But to the people listening to this, you've got to make sure you own the right type of property that's going to help pay for the longest holiday of your life. And for most of the clients we see at Metropole, Brett, they want to leave their properties for future generations. So buying the right property now is not only going to help you build your asset base, but it should set you up correctly for intergenerational wealth. And buying the wrong property, boy, that's going to have long-term consequences.
Absolutely. And, I think moving forward in this cycle, once it's over, we're certainly going to see that two-tier property market, kind of like the Perth and the Sydney example we kind of spoke about. So, the more affluent people wanting to live in the more established areas who can pay more money and have multiple streams of income, probably versus the average Australian who's, I'd suggest, Michael, 80 or 90% of people's wages won't be going up. And there's certainly going to be those affordability issues once we get to that point. And a larger portion of Australians are going to want to enter the market as homeowners moving forward. Our borders will reopen again. So as we kind of say, it is a bit of a social issue. It's nothing we can control, but certainly it's something we can take advantage of as investors and act accordingly.
Well, as you say, more and more Australians are going to want to enter the property market. That's ingrained in our psyche. It's aspirational. But my concern is that they won't be able to afford to, or they won't be able to afford to buy where they want to live. So it's going to be important for now for us to invest in the sort of locations which are going to be where more affluent owner-occupiers are going to want to live, because that's also where more affluent tenants are going to be able to increase your rent. So if you look at it, in my mind, I guess there are three types of neighbourhood. There are discretionary neighbourhoods, people where they can afford to, they've got discretionary money, they want to spend their money, they can afford to do up their homes. There are aspirational suburbs and there are affordable suburbs. So I know we only recommend buying in the first two categories, established money suburbs, where a lot of the owner-occupiers have had their properties, 10, 20, 30 years, or some 40 years, and they've got minimal debt. Brett, when you look at the statistics, 50% of Australians who own their home have no debt against them. And then about 40% of those who have debt have got a minimal amount of debt because they've owned their properties in the property for a while and the values have gone up. So that's established money suburbs, which we like, as opposed to the new money suburbs where first home buyers are purchasing, they've got little equity in their home, they're often 1 or 2 weeks away from broke. And it's not just the owners, but also in those suburbs, the tenants are similarly two classes. And it's not a judge of people again, but the suburbs where there are more affluent tenants, those tenants are going to be able to pay higher rents as their wages go up, while in the outer suburbs, those tenants are, again, probably only 1 or 2 weeks away from broke. So number one, we like investing in established money suburbs. But Brett, I know you also like getting your team to invest in gentrifying aspirational suburbs.
Yeah, that's a good point. I guess just quickly going to your point there on incomes and areas and locations. One thing that probably investors don't understand, Michael, is your retirement is going to be dependent on your tenant's ability to pay rent. So would you prefer a tenant to be, like you said, living paycheck to paycheck, or would you like someone who's probably got a higher paid job, has a higher rate of saving, can pay with more rent increases and rent can increase as well? So I think that's really, really important to understand.
That is a good point. That's right.
And the other thing about gentrification, let me explain how that works and what probably people don't realise. In the newer suburbs, you're generally getting these newer estates and, you're probably paying 50% at best land to asset ratio. But in these newer suburbs, we're competing with homeowners who we see value at $700 and they go on to pay $800,000 for the property. So they're paying emotional, they pay too much. And people think that's crazy. But then the real crazy thing comes 2 months later when I drive past and the person who's beat me on that property has knocked the house over and built $1 million or $1.5 million home. Overcapitalized, spent too much. If you've got that little house around the corner, and that's happening 3 or 4 times in the street, that's really helping you at a street level from gentrification. And then you can broaden it out to, we talk about the shops and the cafes and the nice restaurants and things like that as well. So it's a real ripple effect with those types of suburbs.
So what we're talking about really is where higher income earners, and in general, this cycle, it's millennials, are moving in with new money and they're improving the location. Now, I know your team is looking for 2 properties for Pam and me currently to do exactly that, aren't you? Where we're going to pull down an old home and build 2 townhouses. We're doing one in Melbourne at the moment. We're looking to do 2 in Brisbane. And often these are the next ripple suburbs out from the established money suburbs, the middle ring suburbs of our capital cities.
Yeah, they are. Obviously, it starts to occur. The older generation move out. Their lower socioeconomic housing areas kind of move out of the area, and because of the location we talked about before, those high demand areas with very good walkability, that 20-minute neighbourhood concept we spoke about, good infrastructure, really, really good school catchments. The younger generation, professional incomes, double incomes, higher paid jobs. They're coming in and they're not accepting that the 1960s or 1970s lifestyle. They want to either knock over or they want to, can completely rebuild and renovate to a more modern home. And that's driving up prices in those inner to middle ring suburbs without even our clients lifting a finger.
Basically, you're counting on the location doing the heavy lifting, and then in due course you can do some as well with some renovations or developments as well. But that brings me back to the point I made a while ago about the property you're buying now isn't just for the next 5 or 10 years, but it's going to support your retirement in the future and hopefully help your kids and grandkids. So do you really want to own a property that's already 100 years old now and is going to be 120, 30 years old when you retire and 150 years old when you pass it on to your next generation? Because you just mentioned a moment ago that that's not the way people are wanting to live. They're pulling those down. So while we like buying old properties past their use-by date, that's only so that you can do something with it and manufacture capital growth by doing a development. But there are some types of properties that are just not the floor plan or the way one wants to live in the future. So you've really got to look forward, don't you, as opposed to just what works now.
Yeah, you're 100% right. It's that short-term thinking and that short-termism that get people in trouble. It is thinking longer term. And I think, Michael, that's one trick a lot of investors miss. I mean, property is the only asset where you can add value. We spoke before about, once we get through this cycle, there's probably going to be a period in the middle there for 3 or 4 years where, the market's not going to do any of the heavy lifting. So if you've got the ability to come back and do a renovation or do a development and add some kind of value to the property, you're manufacturing some growth yourself and you're creating more equity. The rents are going to rise. You're creating more cash flow and serviceability. And that's going to help you get into your next property quicker rather than you're waiting those 3 or 4 years out for the market to maybe get moving again.
Now, the other thing, of course, is that some people say, well, but I can't afford that. I'm going to invest in cheaper, less affluent areas. The trouble is that that's going to end up in many cases with the fact that you're going to own an underperforming property once this cycle's over. Those outer suburbs are less likely to gentrify in the medium term. That's not where wealthier people want to move in. That means that homeowners there will never develop the type of wealth that those who own properties in the inner and middle ring suburbs of our capital cities will. So they're going to miss out on the capital growth. They're going to miss out on the rental growth. They're going to miss out on the ability to grow portfolio. And I guess that's why a lot of people are stuck with just one property, or they sell up after a few years.
Yeah, well, what's the statistic? I think it's 92% own either 1 or 2 properties, and they just don't get the growth and the leverage and the compounding out of those assets in a quick enough time frame to build their asset base fast enough. Yeah, like you said, they focus on regional or secondary locations. They might focus on cash flow where they're compromising growth, and it's really compromising their overall strategy, and they don't really have that plan and that we talked about before, that long-term approach.
Well, I think that's interesting that you bring it up because most actually don't have a strategy. So you said it compromises their strategy. We know that most people think that buying an investment property is a strategy. No, that's not a strategy. It's the end after you've done. It's the bit that you can see. It's the 20% of the whole effort that gives you 80% of your results, but it doesn't work unless you do all the other bits first in the right order. And that's why I know when you speak with clients, potential clients, and people who become clients at Metropole, it all starts with putting a plan together, bringing their future to the present and doing something about it. But it's hard in today's market with all the media and the messages that the market's moving so quickly, it's hard not to let emotions get in the way. That's sometimes why it's useful having somebody on your side who's been there, done that, to not just help you do the right thing, but stop you doing the wrong thing.
That's a really good point. Isn't it funny, Michael, when people come to talk to us about property for the first time, I don't think we even talk about the property. I think if you're sitting with someone who starts by selling your property or pushing you somewhere, you're probably in the wrong place, to be honest. But no, you're completely right. It's about having a long-term approach, taking it more of a strategic plan. As you know, it is time in the market. It's that compounding and leverage. So if it takes another week or another month to get it right and to get everything in place, it's not going to be the end of the world in the long run.
Yeah, well, look, we've done numbers and figures. Actually, you and I tend not to because we have clever people in our research department who've done the strategies and done the spreadsheets. And timing is a one-off bonus. Yes, it would have been nice to buy earlier this year when properties could have been 20, 30, 40, 50,000 cheaper. Having said that, though, it's better to buy the right property because the compounding effect of that extra capital growth is better than the one-off sugar hit of getting a bargain. Not that there are bargains around at the moment. I know your team's having real trouble finding good stock.
Yeah, look, it is. And you can just look at the supply and demand of the markets at the moment. There has been a tight supply of stock, especially for really, really good quality housing. Ours is a bit of a needle in a haystack approach as it is. So, combining with that pent up demand at the moment, it is quite a real difficult search.
Having said that, we've always suggested that most properties on the market are not what we call investment grade. So I know one way your team's getting around that is by finding off-market properties. And I know there are blogs about how to do that and others have done podcasts about how to do that. But it is an old boys club, or I've got to be really careful here, an old person's club, because it's who you know and who you know knows to get you off-market properties. It's not available for everybody, is it?
No, look, unfortunately, the average person we spoke about before, Michael, the average investor maybe gets 2 properties in their lifetime. We probably do that most weekends in all our offices around the country. So, we're dealing with these agents on a regular basis. We're top of mind. We're communicating. They've got opportunities coming up. And, if there's a little old lady or someone who doesn't want people coming through their home, there's a long tenant or a messy divorce. If we're top of mind, it's a simple approach for the agent. And the average person just doesn't get access to that. So it's about that longevity and like you said, those relationships that have been formed over, 5 or 10 years.
Well, I know that we just did an audit and Bryce, my son who buys the development sites, found that over the last 2 years, 84% of the properties he bought were off market. We know, David, we'd say it would even be a higher percentage than that. Now, that doesn't mean we don't go to auctions because some great properties are available at auction. Interestingly, we're missing out at more auctions than we're getting at the moment, aren't we?
Certainly are, yeah. Well, that's that emotion and fear of missing out. And again, Michael, in the areas we're buying, people have the ability to pay more. They've got those higher saving rates. They've got rising incomes where probably in other areas it's not as prevalent.
Sure. So the part of what we have to do is protect our clients by, even if they've got deeper pockets, and sometimes you've got to say, hey, that's not the right price to pay for the property. And interestingly, that happened with your team for one of the properties for me. I had more than enough to pay more than the other guy, but it just didn't make sense, did it?
No, that's right. And I know you're talking about another story there, Michael, in our Sydney office where we had the same thing. Our client could have gone well above and beyond where we had, but to our credit and our buyer's agent's credit, we walked away. We could have thrown more money at it, but we saw value at a certain price. We walked away up to a certain value. And interestingly enough, 2 weeks later, we found a better property in a similar complex for probably slightly less than what we're willing to pay, which was amazing. And obviously our review was quite exceptional from that client.
So really what we're saying is, despite emotions being part of investment, because we're human, if we can actually put those aside and not make the FOMO mistakes of overpaying just to get in the market. Having said that, you shouldn't try and get a bargain and keep missing out. And it also means that you've got to buy the right property in the right location and for a fair price, because you don't want to give away too much too early in the piece. If it's your own home, and we help a lot of home buyers, that's a bit different. You've got a bit more leeway, haven't you?
You do, yeah, absolutely. It's especially if it's something that you want with investment. There's probably less of an emotional attachment. It's purely about the numbers. But clearly, if you're a homeowner, you're willing to pay a little bit more to get the right property because you're going to be there for potentially 10 or 15 years.
Sure. So if your heart sings every time you come home, if your eyes light up and if you smile, that's got to be worth something. But again, it's homeowners who are overly emotional and get too far carried away that, again, I think part of the way our team can help them is by tempering that a bit, but understanding that you're allowed a little bit of emotion. I mean, you've got to. It is your home, isn't it?
Yes. I keep telling my wife that as well, Michael.
So, in summary, a property boom that we're experiencing, like we're experiencing at the moment, is going to lift all ships. But at the end of this, when the tide goes out, and it surely will, and that's probably not going to be till 2023, maybe the end of 2022. And I'm not suggesting the property market's going to crash, but it will slow down. What you end up owning is going to be critical, because some properties will still keep increasing in value. Some will remain stagnant for a while, but unfortunately, some properties will decrease in value, and that's what you've got to think about. What are you going to own for the long term, not just what's happening today?
Yeah, really good points, Michael. And sticking to those fundamentals we always talk about. We're never looking at median house prices or vacancy rates or short-termism like we spoke about before. It's always those longer-term fundamentals and getting that right. And it's a particularly important decade to get those fundamentals right, because, as we said before, there's really going to be a two-tier market after this period, and you really want to be in the top tier if you want to get to that next level as an investor.
So if you want to take advantage of the deep research and the on-the-ground experience our team has, I know, Brett, you'd be happy if people contact you. So just go to metropole.com.au and find out about how we can help you take advantage of the property cycle, because you can't just buy any property. I hope that's the message you got from today. So it all starts with putting a strategic plan together for you, and then we'd love to help you by using our buyers agency services. We've got our own on-the-ground team in Melbourne, Sydney and Brisbane, so we don't fly in and fly out. So it gives us a totally different level of perspective. You may want to use our property management, wealth advisory, financial planning, renovation, development service. So we offer a holistic approach. You can use some of those services or all of them. But it all starts by putting a plan together to help you plan to become the person you plan to become. Go to metropole.com.au, find out about how we can help you, leave us your details, and Brett and I'd love to be part of your wealth creation journey.
Yeah, I'd love to. Thanks for your time, Michael.
My pleasure, Brett. Thanks.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to talk to you about the big difference between the rich and the average Australian. So, do you want to know the big secret of why the rich are richer? Of course, many people have studied the topic, many have written about it. Napoleon Hill wrote a book called The 16 Laws of Success after studying wealthy people for 20 years in his classic book, the one we've all read, that he wrote in 1937, Think and Grow Rich. My good friend Tom Corley studied the rich and poor for 5 years, and he wrote his first book, Rich Habits. Then together we wrote Rich Habits, Poor Habits, which has become an international bestseller. Hey, there's a new edition of it out now too, so you can find that at richhabitspoorhabits.com and get the updated edition. But we wrote Rich Habits, Poor Habits, which has become an international bestseller and has been translated into 5 languages. Now, just to make things clear, when I talk about the rich and the poor, this is not a judge of people. They're all important and valuable, but it has to do with the level of wealth they've achieved. And in Australia, there aren't really poor people, or very few, but we're talking about the average Australian. But we've actually found that many things separate the rich from, let's please keep calling them the poor. But contrary to what the poor want to believe, it's not only luck, it's not fate. Tom Corley found that the poor prefer to believe the rich have some advantage that they don't have. This type of thinking enables the poor to remain in their situation without taking any responsibility for it. It's always somebody else's fault, the government or the system or my education or my parents. Now, sure, luck plays a part in life, but lucky people do many proactive things to put themselves in the position to take advantage of the luck when it strikes. So here's the big difference. The poor, and in fact the average Australian, focuses on survival and on instant gratification. They don't think beyond the moment. However, the very rich think and plan very far into the future, 5 years, 10 years, 20 years into the future. Just describing it a different way may help you understand what I'm getting at. The poor think about the moment. They think about paycheck to paycheck, or they don't get checks anymore, do they, but pay period to pay period at the end of the week. The middle class, they're hoping to make it through the month. But the rich, the wealthier, they're planning a year ahead. They're planning their several years ahead for the future. And multi-millionaires, they're thinking decades or so in the future. So if you want more money, if you want more freedom in life, you're going to have to learn to delay gratification. Now, it's interesting how this theme comes up so often in my mindset moments. But successful people have got the ability to work hard to accomplish something which isn't achieved for a long time. They possess higher patience and an aptitude to postpone the enjoyment of their work. That's because they understand that long-term success takes a lot of skill that unsuccessful people don't have or haven't experienced. They know that if you have the easy path now, it's going to be hard later in life, but if you do the hard things in life now, life's going to be easier in the future. So the attributes that the wealthy people have include proper planning for upcoming challenges. They also develop a level of self-confidence, resilience, tolerance. On the other hand, unsuccessful people, by and large, they can't see the forest for the trees. So learning to delay gratification rather than seeking immediate satisfaction, in my mind, is an essential part of success. And that's just as important when it comes to property investing. It takes time to allow the power of leverage and compounding to grow a large asset base of residential properties. Yet too many people are trying to find the next get-rich-quick scheme, the next hotspot, get on top of this quick property cycle that we're experiencing now to get rich quick. It takes time to allow the power of leverage and compounding to grow a substantial asset base. If it happens too easy, if it happens too quickly, it's not going to last. While it takes time to change the ingrained habits and approaches to life that we've all been taught since childhood, the good news is, though, it's entirely doable. So start with small alterations to your thought patterns by acknowledging the habits. That's why I'm making you aware of them. Acknowledge the habits that now try to give you instant, immediate gratification. As I said, remember, if it comes too quickly, chances are you're going to lose it again just as readily. All good things take time. And as Warren Buffett wisely said, wealth is the transfer of money from the impatient to the patient. I hope you got some insights from my chat with Brett Warren today. And if you did, and you know somebody else who'd get some benefit from it, please tell them about the Michael Yardney podcast, or why not tell the world and leave a review wherever you listen to the show. Now, I've got a bonus for you. It's my way of saying thank you for listening to the show. If you go to podcastbonus.com.au, I've got a bundle of books and reports that I'd like to gift you as my way of saying thank you. Now, in between these twice weekly shows, you can catch me on social media. Just look for Michael Yardney. But daily, I leave some commentary, a chart, some thoughts about property for my private Facebook group, which is growing in number by the day. So why not join me on Facebook? Go to Facebook, look for the private Facebook group called Property Update. Look for the Property Update group and join me for my daily commentary. Of course, you can also get daily commentary on Property Update. Boy, there's lots of ways in keeping in contact, but I'll be back again real soon, twice a week on the podcast. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?